Hi guys, this is Investing with JYK, and today we'll talk about some very basic stuff on uh, valuation. I'm going to change the font here to something that's easier to read. Okay, here we go. Okay, so I've received a couple of requests on how to value something. So let's start off with valuing something that's easiest to value. So assuming we have a bond that pays a fixed coupon. A coupon is basically how much they pay you every year. In this case, assuming it's yearly coupon, pay you every year, and it does not default. So, this is good money, as in like the person that sold you this bond has zero chance of not paying you back or not paying you interest, and we assume no interest, right? So this is just the simplest form of bond. So zero credit risk and zero inflation risk. Right. So okay. So let's imagine we have this particular scenario. We have a bond that has a zero face value. That means at the end of its term, so at maturity, it pays you $0, and it has a coupon of 5.5. That just means for every year, it pays you 5.5. How much is this thing worth? That's a very interesting question. Usually bonds have a face value of whatever, let's say 100. What face value means is just at the end of the bond term, at the maturity date, they will pay you this face value plus that year's coupon as well, obviously, and then they will pay you the coupon every year. And in this case, let's assume this thing is face value is 0. How much should you pay for this thing? Clearly, it's worth more than 0 because this 5.5 is worth something, even though it's in the future, right? If I give you $5.5 this year, then at least it's worth 5.5. If I give it to you next year, it's definitely worth more than 0. So how do we compute that? So for this, let's think about a personal scenario. Like, what do you expect? What do you want from this investment? If I expect 10% per year, as in like if I pay $10 now, I want to get paid back $1 every year. Well, that's a simplistic case. Right? Basically, if I pay $10 now, I want $1 next year, and then next year, if I give you again the $1, then I want 1.1 times 1.1, so I want $2.1 on the next year, and so on. In this case, if I pay you, let's think about let's make this 10%, right? So if if we think about just 1 year, so next year you're going to pay me 5.5. That means if I expect a 10% return, all I need to do is I give you 10% less than what you're going to give me next year, right? So I'm using the term NPV loosely, so anyone with financial background is probably gonna murder me because I didn't account for the first year of negative cash flow. But this just complicates this whole thing. So let's just think about the most common sense approach. If I paid you 4.95 this year, and you will give me 5.5 next year, that means I essentially got Right, 5.5 divided by 4.95 is, well, actually that's 11%. Damn, I think I made a mistake here. Let me just correct this. This is gonna be stupid. It's really that divided by plus. Yes. Yes. Sorry. Yeah. Simple. I give you $5 and you give me 5.5, I get 10% return in a year. Simple. And same goes if I give you $5 this year and sorry, if I give you 4.545454 this year and then you give me 5.5, that's actually in 2 years, that's also 10% a year. I mean, you can think about as you know 5.5 divided by 4 point this divided by this crazy number, and to the power of half and minus 1, obviously, because so that's again 10%. So same goes on for, I just ran out of battery again. So, all right. It's the games, man. It's the games. They drain your battery. So yeah, so these are all computed via that formula. So the way you do it is by dividing the future dollar amount, the nominal future dollar amount, by 1 plus the expected return, and to the power of a number of years. Right? And then you just add up all the future values, and that's how much you should be paying. And that is actually 30. I'm just going to sum it up. Current value equals sum of these guys. $33.8. Okay, so let's rework this thing, right? So if I give you $5 this year, today, a year from today, you give me 5.5, I've made a 10% return. If I expect 10% return and you promise me a 5.5 payment in a year's time, I should give you $5. Simple. Repeat the same computation for 2 years, 3 years, until 10 years, and every year, essentially, the future value decreases by 10%. And you add all of them up, and you get the total future value in today's terms. Right? So another way people talk about this is called discounted cash flow. So every year in the future, you would discount the cash flow because if you want to consume, consuming today is better than consuming tomorrow. If everything being equal, having the choice of being able to consume today is better than having the choice of only consuming tomorrow. So this is the value of time. Then if you promise me, $1 million in 1,000 years, maybe it's worth 0 to me because I'll be dead. So for people, the expected return is one thing. The other one is how far in the future this cash is going to come in. For a really old person, if you're 89 years old or 99 years old, maybe you only care about next year or something. If I promise you some payment in 20 years, I don't care. But for most people in their 20s, I promise you a payment of in 20 years is a high chance that I will still be alive to enjoy that, and then I can assign some kind of value. So this expected return is one thing that's personal. Maybe you expect 10%. Right? Maybe you're less greedy. You think, if it's zero risk, maybe I expect only 5%. Let's see what that does to the current value of your bond. It's actually $42.5. You see, as my expectation goes down, that just means I will be willing to pay more for the same thing. This is actually a crucial point in terms of value investing. So you pay more if you're willing to accept a lower expected return. Okay. Now, realistically, the current U.S. The current U.S. 10-year Treasury is actually 2.8-ish. Right? So that's actually only worth $47 if they pay you a 5.5 coupon. And if you buy it fresh, what's going to happen is you're going to pay $100 in face value or whatever number, and they actually pay you just 2.8. So you see the current value is exactly 100. It's like magic. Obviously, this also explains why bond price change with the yield. So imagine the coupon was set when the bond was issued, right? So that never changes. It's fixed coupon, and for some reason, the expected return, the global expected return, because the market prices at the margin. So if the person with the least expected return is going to get 3%, that's how that's going to be the price of the bond. So imagine like people suddenly really wanted cash, right? They want cash more than anything. They don't want to touch bonds. They think everybody's going to default, so they're worried about U.S. government going default and may or may not be reasonable. So say they now demand, unless you pay me 5%, unless I get a 5% return, I'm not going to lend you any money, right? But somebody just bought a bond that is for $100 face value, and it pays a 2.8% coupon. Let's see what happens to the value. 5%. Ta-da! So now your bond is suddenly only worth $83. All the future cash is only worth $83. So as the yield goes up, the price of the bond goes down. This is I will explain this further in the future in regard to stocks. But if you think about this, similar things, if the stock market, if everything is stationary, if people start demanding higher returns, the current value of the stock, i.e. the price, will drop. And if people are okay with lower returns, the current value would increase. So imagine the 2.8 now suddenly dropped to 1%. Now your bond is worth $117. So yeah. Okay, so today we just talked about, well, I guess you can ignore this. I was going to do something different, but just focus on this side. Today we just talked about how to value future cash flow, and how the yield, essentially the expected return, affects the price of a bond. And we did not include any complications as in default risk or inflation risk, anything like that. And the change in expected return, i.e. the yield uh, uh, fluctuation, is frequently called, I think it's just the duration risk. I think that's the name. I forgot. Correct me if I'm wrong. Yeah, so that'll be it for today, and we'll probably do the stock valuation next time, and we'll stick with a super simple case. All right, good night. Oh, don't forget to subscribe and click like or dislike.